Welcome back to the deep dive. Today, we're really tearing into the corporate filings of a powerhouse you probably interact with almost daily, a leading global maker of doors and windows.
That's right.
And this isn't just about, glancing at quarterly earnings. We are diving deep into their strategic documents, the actual plan laying out how they aim to transform, frankly survive, and maybe grow in what's clearly a tough, high-pressure market right now.
Exactly. So for you, the listener, our mission is to cut through all that complexity. We want to pull out the key data points.
Mm-hmm.
We need to get a handle on their multi-year commercial strategy, the pretty drastic restructuring they've been doing,
Yeah.
and the big financial and legal hurdles they dealt with in 2024.
Right, and the message from the top, from the CEO, seems crystal clear. It's all about efficiency, surgical efficiency.
Yeah.
Their main priorities look like two big things. First, create a leaner, more effective global manufacturing network.
Makes
And second, build real strategic clarity across the whole company. Especially, it seems, tackling that performance difference between North America and Europe. They're trying to shed complexity to, move faster.
Okay.
So let's start with just the sheer size of this operation. When we say global leader, what does that actually look like on the ground?
It's huge and spread out. We're talking 79 manufacturing and distribution sites.
79.
Yeah, across 14 countries,
Uh,
mostly North America and Europe, as you said. They are genuinely fundamental to the construction supply chain globally.
and the revenue numbers really show where the main engine is, don't they? It's heavily tilted towards North America.
Oh, definitely. North America pulled in about 72% of their net revenues in 2024,
Wow.
which leaves Europe way behind at around 28%.
Yeah.
Big difference.
And it's interesting how they actually reach the customer, too. I think many people might assume new home building is their biggest driver, but that's not quite right, is it?
No, not at all. Residential repair and remodel R&R is the biggest piece of the pie. Pulled in 36% of revenue last year.
Or new residential construction was 39%, and then non-residential makes up the last 15%. That strength in R&R is, well, it's a really crucial cushion when new housing starts slow down, which is definitely a theme this year.
Absolutely. Now, looking at the products, doors are clearly king here, making up 63% of revenue.
Yeah.
But they aren't just selling, basic interior doors, are they?
Not entirely, no. Doors are the main profit engine for sure. That includes those high-volume molded interior ones you see everywhere, North America, France, the UK.
Right.
But what's really interesting is their high-performance European non-residential stuff. Doors with specialized features, soundproofing, serious security, fire resistance, even Arctic-ready materials. They cover the whole range.
And windows, they account for about 20% of revenue. It seems like there's also a push towards specialty items there, too. I saw a mention of impact windows for coastal areas.
Yes, exactly. And for their North American wood products, a really big deal for them is heavily marketing their proprietary Orlast wood treatment.
They really stress that this process penetrates and protects the wood through to the core, not just a surface thing. That's a huge selling point for quality and durability, especially in those pricier wood window and patio door lines.
Okay, let's pivot to a number that really stands out in terms of risk, something for you, the listener, to definitely track: customer concentration.
This is absolutely critical. The company's health is really tied up with a surprisingly small number of big customers.
How small?
Their top 10 customers. They accounted for 46% of consolidated net revenues in 2024, almost half.
Wow.
And you have to name names here. The Home Depot was 16% of total revenue on its own,
16%.
and Lowe's was another 12%. So when you've got 28% of your entire global sales coming from just two companies, well, pricing power and managing those relationships become, frankly, existential issues.
Yeah, no kidding. Okay, shifting gears to their actual game plan. The North American strategy seems built on what they call 4 pillars. They want the right product and brand offering, the right cost, a frictionless experience for customers, and disciplined planning and execution. Sounds straightforward enough.
It sounds straightforward, but they're defining some really specific efficiency goals behind that. And this is where that strategy links directly back to the financial pressures we just talked about.
Okay.
They need these pillars to work because, well, every dollar counts with those economic headwinds and that huge jump in restructuring costs they had.
So how does that translate practically?
It means things like targeted quality improvement programs, investing pretty heavily in automation, and using their massive size to streamline sourcing and get better deals on materials.
It sounds like a classic top-down efficiency push,
Yeah.
but I noticed in their filings they also mention something called the all-in transformation. Are they trying to manage the human side of this change too? Is this real or just corporate jargon?
It seems like a genuine effort to get employees on board with what must be some painful changes.
Hmm.
They describe All-In as an employee-led change network. Its job is apparently to find and implement improvement ideas that come directly from employee survey feedback,
Interesting.
focusing on things like organizational health, making sure everyone's aligned on strategy, and encouraging, ownership behaviors.
Hmm.
When you're closing plants and cutting deep, you absolutely need that internal support to keep things running smoothly.
Yeah, makes sense. But despite those internal efforts, they can't really dodge the external economic climate, can they? Looking ahead to 2025 in North America, they're clearly flagging some major headwinds.
Oh yeah, it's basically the triple threat facing the whole construction sector.
Which is,
Persistently high interest rates, which obviously dampen building and remodeling activity, and then continued inflation hitting labor, freight, and raw materials.
right.
All that just eats into profit margins. It forces them to be really disciplined on pricing, which, as we just discussed, is tricky given how much they rely on Home Depot and Lowe's.
And we also have to remember the seasonality factor, right? Profitability isn't evenly spread through the year.
Absolutely correct. Being a building products company, their sales are typically much higher in the second and third quarters, Q2 and Q3.
Right, the peak building season.
Exactly. That's when construction and R&R are busiest.
Yeah.
So they really depend on those 6 months to generate the lion's share of their annual profit.
Okay, so all this pressure, internal and external, it really came with a hefty price tag in 2024, especially on the balance sheet. Let's talk hard numbers. That huge financial hit. The $94.8 million non-cash goodwill impairment.
Yeah, that's a big one.
For listeners maybe less familiar with these filings, can you quickly explain what goodwill actually is and why writing off almost $100 million of it signals, well, some serious struggles?
Sure. Goodwill is essentially an intangible asset. It's the premium a company pays when it acquires another business above the fair value of the actual physical asset. It represents things like brand reputation, customer lists, maybe expected synergies. So when they take a goodwill impairment, it means management has decided that that business unit isn't going to generate the future cash flows needed to justify that original premium.
So an admission things aren't worth what they thought.
Basically, yes.
Yeah.
It's acknowledging those intangible assets aren't worth what they paid.
And the breakdown of that $94.8 million is really telling. The biggest chunk, $63.4 million, hit the Europe reporting unit. What caused such a, well, devastating hit over there?
Management pointed directly at the macroeconomic forecast for Europe, specifically things like prolonged high interest rates and geopolitical uncertainty.
Right.
That led them to drastically lower their revenue growth expectations for the region. That $63.4 million charge was so large, it basically brought the carrying value of the European unit right down to its rock-bottom fair value. It signals a really deep structural issue in that segment.
But the other $31.4 million impairment charge hit North America, which is usually their strong segment. And this wasn't broad economics, was it? It was tied to that specific, very long and complex antitrust lawsuit with Steves and Sons.
That's right.
Why does a legal ruling lead to a balance sheet write-down like that?
Because the final court order in the Steves case mandated a divestiture. They were forced to sell their operations in Towanda, Pennsylvania.
Ah, okay.
That sale actually closed just after the year end, January 17th, 2025. But once that court order was final in 2024, accounting rules meant they had to classify those assets as held for sale, and they had to adjust their book value down to what they realistically expected to get from selling them.
Yeah.
That $31.4 million was the immediate accounting hit reflecting that forced sale price.
Got it. So beyond that big goodwill hit, we also saw cash spending on restructuring just skyrocketed. Restructuring and asset-related charges jumped, 90.5% in 2024, up to $68.1 million?
Yeah, a massive increase.
They're clearly spending a lot now to hopefully save money later. But how long can they keep burning cash like that, especially with those macro headwinds still blowing in 2025?
That really is the core tension, isn't it?
Yeah.
It's an aggressive strategy, and yeah, a painful one in the short term.
So what drove that huge spending jump?
Primarily closing manufacturing plants in both North America and Europe, and also a large-scale overhaul of the European operating structure to make it leaner.
Right.
They seem to believe that if they don't take this costly action now to right-size the whole network, they just won't be competitive when the construction market eventually turns around.
Yeah.
It's a very expensive bet on structural survival.
Speaking of costs and legal issues, let's touch on their risk mitigation efforts. Environmental cleanup can be a really long-term, costly liability. Any progress there?
They did score one win on an old issue. There was a wood fiber waste pile at that Towanda, PA site, a historical problem. They successfully removed it in December 2024. That satisfied a consent order they had with the state regulator, the PADIP. So that specific long-term liability is now off their plate.
Good news there. But there's a bigger, more expensive issue still lingering in Everett, Washington, right? That sounds pretty substantial.
It is. It's a long-term cleanup project at a former manufacturing site. And the estimated costs are significant, somewhere between $17.4 million and $33.6 million.
Oof.
Now, the potential good news is that liability might be shared among several other parties, what they call PLPs, or potential liability parties. Basically, others who might have contributed, like the Port of Everett. They've currently set aside $11.8 million as their estimated share based on how those allocation talks are going. Still a hefty sum, though.
Definitely. All right, shifting to the financial structure itself. All this transformation is happening while they're carrying a pretty big debt load, about $1.19 billion outstanding at the end of 2024.
Right, and that debt level isn't just about interest rate risk. It also comes with restrictive covenants under their main credit agreements.
Covenants? Those are basically rules imposed by the lenders, right? What do they restrict in practice?
They limit the company's flexibility. Things like taking on more debt, selling major assets, and, importantly, paying out large dividends to shareholders. They can't just shuffle cash around however they want.
So constrained. To manage the risks they can control, like interest rates and currency fluctuations, they're using hedging instruments.
Correct. They put on interest rate collars covering $100 million back in February 2024. And then late in 2024, they implemented foreign currency derivative contracts, things like forwards, with a total notional value of $163.3 million.
And just quickly, notional value for you listening, when we talk about derivatives like this, it's the base amount the contract is linked to.
Exactly. It's the principal value they're trying to protect from currency swings, especially important for buying raw materials often priced in foreign currencies.
Okay. And finally, just a quick mention of compliance and sort of governance aspects. They highlight human capital management, things like training, measuring organizational health through that global employee survey.
Right, which ties back to that all-in transformation idea. And understandably, for a global manufacturer, cybersecurity is flagged as a priority.
Standard practice now, really.
Pretty much. Their strategy uses the NIST framework continuous monitoring, and importantly, they carry insurance to help cover potential losses if a major cyber incident did happen. Just acknowledging modern digital risks.
Okay, so let's try and pull all these threads together. What's the core story here? It looks like this company is deep in a very costly, very aggressive strategic overhaul.
Yeah.
Intensely focused on efficiency, streamlining the footprint by closing plants, and trying to embed a new culture with this all-in initiative.
Absolutely. That efficiency drive is clearly essential for them. But wow, it came at a steep price in 2024.
Yeah.
You see it in that huge $94.8 million goodwill impairment and the near doubling of restructuring costs. And there's this real dichotomy. They're dominant in North America, that's 72% of revenue, remember, yet they're seriously struggling in Europe, where the bad economy forced that massive write-down. The global scale is kind of masking some significant regional vulnerability.
That tension, massive scale versus localized market risk, that seems key for you to watch.
Well,
So for the learner today, here's the final provocative thought to chew on.
okay.
Given this huge investment they're making in product innovation like ORLS, impact windows, and all this costly efficiency work, but also knowing how incredibly reliant they are on just two retail giants, Home Depot and Lowe's,
Right.
how are they going to balance the absolute need for disciplined pricing they have to recover these transformation costs against the very real risk of losing one of those massive customers? Their own filings even state that their pricing strategy has in the past and may in the future lead to the loss of certain customers.
It really boils down to whether their leaner, supposedly more efficient manufacturing setup can actually deliver product quality and cost advantages that are strong enough to justify price points those huge retailers won't just reject. It's a high-wire act.
A high-wire act indeed. That's where we'll leave our deep dive for today. We hope you feel fully up to speed on the high-stakes transformation happening here. We'll catch you next time.